Bloomberg Audio Studios. Podcasts, radio, news.
Joining us right now, Torsten Slok, Apollo Global Management, hugely read on Wall Street, of course, off of his iconic work at Deutsche Bank as well. Torsten, 12 months forward, where's real GDP?
I still think it's strong, but I do think that the weather report you just had with still mildly hot economy, mildly hot weather, but with the risk that we may have some slowdown coming, maybe 12 months, but more 18 months into the future. The fear you can have is that higher for longer ultimately begins to bite harder on levered balance sheets for consumers, on levered balance sheets for firms, and levered balance sheets in the banking sector. And that could potentially create that dreaded recession that we've been worrying about for so long. But so far, for the next several quarters, we still think that the tailwinds to growth are very strong from fiscal policy and from easy financial conditions.
Torsten, you've been pretty consistent here in your call that this Federal Reserve doesn't really have to cut rates in 2024. Do you still believe that? And if so, why?
I still believe that because what I think, the first test is, well, if we literally just quote unquote look out of the window and see how are things going in the incoming data, non-farm payrolls at 272,000, that's a really strong number. There's some debate about whether some of that maybe is driven higher because of immigration. Wendy Edelberg and Tara Watson at the Brookings Institute wrote a very important paper suggesting that maybe the equilibrium growth in non-farm payrolls is about 100,000 higher than normal because of immigration. But I still think that strength in the numbers across the board. We had a little bit of weakness maybe in retail sales earlier this week, but at the same day, we also had industrial production was very strong. So jobless claims also looking good. It's just hard to see where that slowdown is that so many people are worried about. So because of that, we just don't see the urgency for the Fed having to cut rates.
Are you surprised that the higher rates haven't impacted the consumer more? I mean, it's tough to get a plane seat. It's tough to get a seat on a cruise ship. It's tough to get a seat at a restaurant. Talk to us about how the consumer's reacting.
Yeah, this is very important, Paul. So what I think is very critical in that discussion is that the transmission mechanism of monetary policy was actually working last year exactly as the textbook would have predicted. The Fed raised rates in March of 2022, and the most highly levered consumers started responding because you saw delinquency rates go up on credit cards, delinquency rate go up on auto loans, especially for consumers that have more debt, which generally are consumers that are younger also, and consumers that have lower FICO scores. Same thing for corporates. You began to see default rates go up for high yield, default rates go up for loans. So in other words, balance sheets that had a lot of debt were first hit by the Fed raising rates. But what really is unique at the moment, and this is the answer to your question, Paul, is that for consumers, they have locked in during the pandemic mortgage rates. As we all know, 95% are 30-year fixed at very low levels. Likewise, for corporates, the vast majority of credit markets is IG, and IG companies locked in and termed out also very low interest rates. And as a result of that, the transmission mechanism has just been weaker than what it normally is. And that changed with the Fed pivoting to dovish, because then on top of that, not only was the transmission mechanism weak, but we also got a tailwind from easy financial conditions with S&P up as much as we have seen.
Torsten, you've led on this, and it's your best chart of the many charts you put out. 10 years ago, folks, the share of mortgages below 4%, Paul, was 30%. As a course of conversation, it's doubled. I mean, the number of mortgages below 4% has doubled in 10, 11 years. And Torsten, that goes directly into the transmission mechanism. You know I'm very negative on the dots. Do the dots of the Fed, have they adjusted to the slower transmission mechanism?
Well, I do think what is very important in the last FOMC meeting, and you have also talked about that on surveillance radio, because what we saw was, of course, that the Fed went from instead saying 3 cuts in 2024 to now saying 1 cut. That on its own is an admission that we were wrong at the Fed. Right. We thought that we would have 3 cuts. Now we think we're going to have 1 cut. So in some sense, the Fed is coming, quote unquote, back to the view that maybe there is no strong arguments for being in this urgent pace of having to cut rates as quickly as they thought just 6 months ago.
We're thrilled you're with us for the entire half hour. Torsten Slok, we're going to go to Michael Barr News, but I'm going to really come up on beating this. Folks, I haven't mentioned this on air yet, but it's asymptotic 2024. What is he talking about? Come on, Torsten, all the asymptote discussion. Ethan Harris, retired from Bank of America, leading the charge on this, a few others as well. They're lost, and they're extending out the x-axis as far as they can. It's that simple, right?
I agree. I think that what is very important here is that we have unleashed some fairly significant powers with inflation going up. And one point that's also very critical in this discussion is that if you look at Michigan 5 to 10 year inflation long-term expectations, the median is still very well behaved. So the median household still thinks inflation will be 3.1, which is where it's been for the last several years. But if you look at the mean, you will see a significant increase in one half of the population expecting that inflation is going to be dramatically higher than the other half. And if you look at the sub-questions in the University of Michigan, who is it that's expecting inflation to be higher? It is, generally speaking, the bottom 33% of household incomes, meaning lower income households expect much higher inflation than high income households. And it's generally also people with high school or less education that expect inflation to be a lot higher. So you're beginning to see some divergence in inflation expectations. And this is opening up a very important debate in the Phillips curve that you and I, Tom, had talked about for years, where if inflation expectations for half of the population are very, very high, what does that mean for when the Fed says that inflation expectations are under control? Yes, the median may be under control, but there's a significant part of the population that's still worried about inflation.
Torsten, talk to us about what concern do you have about this, maybe the commercial real estate market in this country? It feels like there's still a big shoe or two or three to drop, but maybe not. How do you think about that risk here as we look around to some of these big cities and see a lot of vacant office space?
I think the important data point first to keep in mind is that the price per square foot for office nationwide is down more than 40% from the peak. So if we think about what that means, that of course means that there's a lot of office that has been reset at a lower level. Now, there's some important differences across the country, of course, with the Sun Belt, with the West Coast relative to East Coast, relative to metropolitan areas. But the bottom line is really that, when an asset price goes down more than 40%, and in particular, when the financing of that asset price is something that normally is reset every 5 years, then we still have a maturity wall in commercial real estate, in particular in office, that is really, really steep. For other types of commercial real estate, things look a lot better. So, of course, you have warehouses, industrial, you have apartments, multifamily, shopping malls. You, of course, also have data centers. There's some very idiosyncratic stories across the different types of commercial real estate. But the main issue still that we should all be watching is office, because that is just still where most of the downward drift is.
Torsten, another economic issue that's really been, or I guess this discussion point over the last 18 months as we look around the world, is this concept of American exceptionalism from an economic perspective, the commercial real estate issue notwithstanding. How real is that, the U.S. economy strength vis-a-vis the rest of the world, and how do you explain that?
Yeah, this is really important. So there is a structural discussion exactly about, is the U.S. exceptional? And the U.S., of course, is exceptional because of large capital markets, much more spending, broadly speaking, across the board, including on defense, including also on the role of the U.S. consumer. So simply because the U.S., as the biggest economy in the world, playing this very substantial role, it does, generally speaking, attract capital. On top of that comes the more cyclical arguments, namely that the U.S. business cycle just happens to be a lot stronger than the business cycle in Europe, the business cycle in Japan, Canada, Australia, emerging markets, and of course also China. And when the U.S. is stronger, then that means, of course, as we're seeing and as we're talking about, then rates will be higher for longer in the U.S. than elsewhere. That's, of course, what we saw with ECB cutting rates. The Bank of England today staying on hold, but now signaling clearly that rate cuts are coming. All that argues for still more upward pressure on the dollar, because the U.S. is exceptional not only from a structural perspective, but also at the moment exceptional from a cyclical perspective. So with that backdrop, when will that exceptionalism from the cyclical perspective change? When the Fed begins to cut rates, then we could begin to see the dollar begin to turn really south in a much more substantial way. But given that's still now being pushed out repeatedly, then I still think the dollar will be going up, and the exceptionalism does play a very important role, both on the structural side and on the cyclical side.
Torsten, one more question. We've got to go to breaking news, but I think this is too important. Back to the idea of an x-axis that goes out forever. and the new idea percolating of an asymptote, I guess down to 2%. Is the asymptote a smooth glide path down to 2% out there somewhere, or is it 2.x%?
So if you mean inflation, of course, then the issue is that inflation at the moment, as you know, is 3.3. The Fed's target is that it should be 2. 3.3 is not 2. So that's why FOMC members repeatedly talk about, well, maybe we do need to wait a little while longer before we start cutting rates. And to your question, will we have an asymptotic move down from 3.3 to 2.0? I think that the answer to that is absolutely not. We still have significant tailwinds from fiscal policy, the CHIPS Act, the Inflation Reduction Infrastructure Act, are all policies that are designed to lift growth over the next several years. Likewise, we have a very strong tailwind from easier financial conditions. As long as the AI story and the stock market goes up, we still will have, like we saw this earnings season, strong demand for airlines, hotels, restaurants, concerts, sporting events. So the short answer to your question is, I worry that inflation is not going to come down in a straight line to 2% from the 3.3% where we are today.
Torsten Slok, thank you so much. With Apollo.